Hey, welcome. Today we are diving headfirst into the glittering and, let's be honest, sometimes confusing world of precious metals.
You've probably seen the headlines, right? Gold and silver are just on an absolute tear, smashing records. There's a ton of buzz, and you know a lot of money is changing hands.
Which, of course, brings us to the million-dollar question, or maybe the 78-ounce question. If you're looking to jump in, where do you put your cash? Do you go with the classic safety of gold or the industrial power of silver?
Okay, so here's how we're going to break it all down. First, we're going to talk about the one number that really frames this whole debate. Then we'll put gold and silver head-to-head. After that, we'll get into the nitty-gritty of how you can actually invest. And we'll wrap up by looking at the big picture and where this all fits in your strategy.
First things first, let's talk about what is, without a doubt, the single most important number when you're comparing gold and silver.
It's called the gold-to-silver ratio, and I know, it sounds kind of technical, but it's actually super simple. It's just how many ounces of silver it takes to buy one single ounce of gold. That's it. It tells you, at a glance, how they're valued against each other.
And right now, that number is 78.29. So you'd need to trade over 78 ounces of silver just to get your hands on 1 ounce of gold. Keep that number in your back pocket because it's going to be really important. So, what does a number like 78 actually mean? Well, a high ratio, like we have now, suggests to a lot of investors that silver is cheap compared to gold. The gap is wide. On the flip side, when that ratio is low, it means the price gap has shrunk and silver might be seen as expensive.
All right, now that we've got the ratio down, let's get to the main event. It's time for the showdown between these two metal heavyweights.
And this chart tells you almost everything you need to know about their personalities. Gold is the king in the castle. Look at that. Almost 90% of it is just for investment in jewelry. It's a store of value. But silver is the factory worker. About half of all silver is used in industry. It's in your phone, solar panels, everywhere. It actually gets used up.
Now, here's where it gets really interesting. We pull about 8 times more silver out of the ground than gold every year. But gold's price is nearly 80 times higher. So what gives? Well, two big things. Value density, it's just way easier to store $1 million in gold than in silver, and durability. Because silver gets used up in industry, almost all the gold ever mined is still around today, making it this ultimate permanent form of wealth.
Okay, so those are the fundamentals. But let's be real. As an investor, there's one question that matters more than anything else.
And here are the cold, hard numbers going back almost 100 years. Gold gave you a return of about 4.8% a year. Silver, a little less, at 3.7%. Now, the good news is both of them beat inflation. But then you look at the S&P 500, and it's not even a contest, over 10%.
And if those numbers don't paint a clear enough picture, listen to this from Bankrate. An investment in large stocks back in 1925 would have grown to be worth 146 times more than that same investment in gold. Wow, that's a pretty powerful reminder about where long-term growth has really come from.
So let's say you've heard all that and you still think, you know what, I want some metal in my portfolio. The next question is obvious. How do you actually do it?
Well, you've basically got 3 main options. First, the old school way, physical bullion. You buy actual coins and bars. You can hold it in your hand, but you also have to figure out where to store it safely. The modern way is through ETFs. They just track the price, trade like a stock, and you don't have to worry about a safe. And finally, you can buy stocks in the mining companies themselves. This can give you some leverage, but you're also taking on the risks of that specific company.
Now, here is a fantastic pro tip if you do decide to buy physical metal. You've got to pay attention to the markup. That's the little bit extra you pay over the raw market price. And here's the deal. For smaller purchases, say under $1,500, you'll usually get a better deal on silver. But once you start investing more than that, the markups on gold tend to be more cost-effective.
Okay, we've covered the what and the how. For this last part, let's zoom all the way out and talk about the most important question of all, the why. Where does this stuff actually fit in your financial life?
And on this, pretty much every financial expert agrees. Precious metals aren't supposed to be the engine of your portfolio. Think of them as the shock absorbers. Their main job is to provide some diversification, a little bit of a safety net when the economy gets rocky.
And that brings us to this really common rule of thumb, the 10% rule. A lot of advisors will suggest that you keep your total precious metals holdings, that's gold and silver combined, to no more than 10% of your entire portfolio. That way you get those diversification benefits without giving up too much of the long-term growth you get from your other assets.
So when you get right down to it, the debate isn't really about which metal is better. The real question is, which one fits your story? Are you looking for a stable shelter to ride out a potential financial storm? That's gold's classic role. Or are you looking to harness the more volatile, industrial-powered lightning of an economic boom? That is silver's game. The right answer really just depends on the story you're trying to write.